All right, all right. How's everybody doing this morning? We had a fantastic class last night at the university, and so I'm very happy and glad about that. Very much excited, looking forward to Friday's class, where we're going to tie this whole thing together. All right, so very excited about that. So make sure you come to Friday's class down at the university. We're going to have a good time there. So today, though, is the lab for last night's class. And last night, we learned all about the calculators that we're going to use to be able to do some of the research that we need to be able to find the stocks or the symbols or the ETFs, exchange traded funds, that we want to put into our portfolio. And we talked a little bit about the calculator. And so today in this class, we're going to go through and we're going to play with the calculator. All right. And we're going to talk about some of the different funds that are in here. Now, the current calculator, I want you to go over, this is how you're going to access it. You're going to use this little code right here. And I showed this to you last night in class. So take your little camera and scan that code. Just point your camera, take your camera and point it at it. Don't take a picture of it. Just point it at it. And if you point at your camera at it, it'll come up with a little yellow thing on there, a little yellow connector. And then you touch that and it'll open up and it'll take you right into the course. See that? So see that? Where's the camera? So there's the course right there. Now, of course, you're going to want to save that URL and you're going to want to go and look at this on your big computer too, your laptop. All right. Save that link so that you can look at it on the big laptop. Now, as you come down through this course, what you're going to see is this is a course that's been made from a number of articles from Pitt News Magazine. So Pitt News Magazine, over the last 2 years, we've been talking about these funds. And so anytime we do a lesson or we talk about one of these funds or one of the topics that are very important, we write an article in Pitt News Magazine. And that's why you need to have a subscription to Pitt News Magazine, is because as we go forward, there's been a lot of changes in this market already just in the last year, 2 years. There's so many things that we want to tell you about what's going on with these high yield funds, these high yield ETFs. And so to stay in touch and to learn what's important and the things that you need to know as we move forward with our portfolios, they'll be published in Pitt News Magazine. And then I take those articles out of Pitt News Magazine and I put them here because a lot of you didn't have a subscription over the last year, but there was so many articles that were so good about what we did in there. I created a course out of it. I took those articles out, and that's what you see here. So a lot of these are articles from Pitt News Magazine, and that made the course. And there's a lot more. I mean, of course, this is just the articles that have to do with your universal basic income or your high ETFs, high yield ETFs, yield first ETFs. There's so much more in Pitt News Magazine. This is not by any stretch of the imagination all the articles in Pitt News Magazine. This is just the ones that appeared in Pitt News Magazine for those high yield ETFs. So I would recommend you watch all of them, of course. They're all very important, and they're going to help you have a better understanding of your portfolio and how to build this thing for wealth. But if you're going to only watch one, all right, if you're only going to watch one, you want to do this very last one down here. All right, this is the one that kind of ties and wraps the whole thing up in a big, nice bow and sticks it out there. The problem is if you just go right to this one without listening to the others, you might not understand this one. But if you've taken the class, you probably will understand it. Maybe to some degree. I don't know. I think you should do them all, obviously, but that last one is kind of a big, long one that ties everything together. It's kind of the summary. So there's your course. And then as you come down, you see these are the resources. Now, Portfolio Matrix is the software that we're creating. It's still in beta. It's not a release version by any stretch of the imagination. Still has some bugaboos in there. But we want you to join it because we can then use you as a guinea pig. All right, let's be honest about why we want you in there right now. We need people to come and join us in Portfolio Matrix so we can make Portfolio Matrix super wonderful and great. And we need a few people willing to jump in there with us early and let us use your account as a test site, right? We're going to work with you individually, one-on-one, to go in, load your account, and see what it does in Portfolio Matrix and see if there's any bugs that we need to work out. And then we can let you use it. And then you can say, hey, Lan, that's a great feature here, but I would really like to see this. And then, oh, I'd really like to see this, or I don't understand this. How can you make it more clear? And then we can continue to program on the software to make it world class. All right, because that's what we're really going for. Is we're working on there's just nothing like this out there. There's a few little programs that do a couple little things. They just don't do it the way we want to do it. All right, they don't see the world the way we see the world. Everything's been built for, the way that we've always done dividends in the past. And for those of you who've taken my class, you know that there's three structures in the stock market. There's the sandbox 1, there's sandbox 2, and there's sandbox 3. And all the other programs that are out there, they kind of work off of sandbox 2. Well, that's not good enough for us. We want sandbox 3. There's a whole new world here, and all these other little programs that are out there that do dividend investing, they don't touch the way that we need to do it with these new high yield ETFs. And so it's very important that we get a software program that does that for us. We've been trying to do it for years, doing it with my spreadsheet, right? So those of you who are familiar and have been following along in this class with me, you know that this is my spreadsheet, right? So as we come through, I've been working on various different versions of the spreadsheet. And so as the spreadsheet gets more and more sophisticated, you can see that I've built out my big spreadsheet. Now this spreadsheet is the way that I've been tracking my portfolio for 2 years. And it's been really wonderful, but it's so limited in what I can do. All right. It's so limited. All I can really do on this spreadsheet is just barely track the one little thing that I've got going here. It doesn't do anything else. It's as complicated as it looks. And it is a little bit complicated. And as hard as you think it would be to maintain this, it is hard to maintain this. It takes me hours and hours and hours and hours a month to keep this maintained, and we're up to date. And I keep trying to make new versions of it. I'm working on a simplified version here that has a little bit different approach. So there's this one in here that I'm working on, and it's not done, but I'm giving you this anyway. I'm giving you this spreadsheet. And so this spreadsheet is right here. You can download it right there. All right. So this is the button to download that spreadsheet. If you click on it, it should pop up and give you the ability to download your spreadsheet. And then this is the the slides for the course that goes along with that I created. This kind of the whole course, all the slides that you've been watching down at the university, you can scan that, and that'll give you kind of a comprehensive PDF of all the slides that we've had in the course. So if you just want the slides, that's a good place. And I'm going to send you the ones because I've changed them. Obviously, I told you I update the slides and make whole new slides for every time I teach a new class at the university. I make new slides. These are the old slides, but there's kind of a boilerplate library of slides that I've used, and you can have those too. And that's what that is. And then, of course, this is the software that I like to use. This is the professional version of the software for our students. This is Track and Trade, and this is, you just click that. That's a link that'll take you over to the Track and Trade website, and this is where you're going to get your Ferrari software. All right, so you can just click on that, and that'll take you over to the website. Of course, this is Portfolio Matrix, and then this is the UBI calculator, and this is what we're going to work with today. All right, we're going to spend some time right here on this, what I call the UBI calculator, which is actually the dividend calculator. And it's where we were working last night, and you saw some of the examples in there. And so this is what I want to work with on you today. We're going to go through and show you how to use this. And I'm going to show you all three calculators. And this is really fun. Now, I wrote this myself, not really. I had Grok help me. Grok's a programmer, right? Grok, the AI system, is a programmer, and he helped me write this software. And I'm trying to expand it and make it bigger, but Grok doesn't quite understand what I want. So I'm having a problem. And what I want is I want to add some of the new funds into it that we talked about last Wednesday. So these are all the funds from, and Grok didn't do a very good job of listing them, but these are all the funds from the Yield Max management firm, right? YieldMax is one of the firms that manages all these ETFs. And then this is the Granite Share list right here, much smaller list. And then this is the Round Hill list. And then this is the Curve list. This is the Defiance list. This is the Axis list. This is the Neos list. This is the Nicholas Wealth list. So there's about 5 companies that have jumped on the bandwagon and started doing these high yield funds. Now, they don't all do it the way YieldMax does it. They use different strategies to try and get these high yield funds. They've got different ideas, so they do different things. And some of them are doing really well. Granite Shares is really a cool one. They use put options instead of call options. So hold on, I'm losing my voice. All right, so we're going to be looking at these funds. We're going to go in and play with them. Now, the reason I bring that up is because Grok, I'm trying to get these Granite Shares and these Round Hill and these Curve Investments, Defiance, I'm trying to get those into this little calculator. So just keep watching for that, and eventually I'll get them in there. But for now, the little calculator only has YieldMax. So if we come in here and let's just start off with the investment calculator. Now there's 2 different versions of the investment calculator, and you can see both of them right here in this little drop down. So it comes in here and it's just, it's like a prompt. So it's really simple. It says, what do you want to calculate? Well, I want to calculate how much income can I earn, or do you want to calculate how much do I need to invest? So it's 2 ways of approaching the same problem. So how much income can I earn? Well, I've got 10 grand. How much money can I make off of that depending on what I put it into? So if I have all these opportunities, all these different funds that Lane just showed me, huge list of all these, which one do I pick? Sorry, I'm going to have to take one more quick break here. Too early in the morning after a long night of talking. All right. So what we're going to do is we're going to say, how much income can I earn, or how much do I need to invest? So if you approach it from a different point of view, how much income can I earn? I have 10 grand. Which stock, if I put it into all these different funds, which one would make me the most money? Which one would be the most aggressive? Which one would require the most risk? Which one would require the least risk? And then kind of help me decide. And then this one here is, well, how much do I need to invest? Let's say I want to be independently wealthy, right? Like we talked about last night. What does independently wealthy mean to you? It means different things to different people. A lot of people think when you're independently wealthy, that just means that you've got money dripping off your fingers and you can buy anything you want in the whole world, and you can go out and buy 10 cars and big houses. That's independently wealthy. Well, sure, that guy might be independently wealthy, but to become independently wealthy, you don't need that kind of money. All you need is have enough money that you don't have to go work for somebody else. Then you're independently wealthy. All right. So if you can live on $3,000 a month, well, that's all you need for income, and you're independently wealthy. You don't have to go work for anybody else. If you've got assets that are producing and providing you with $3,000 a month, you're independently wealthy. All right. Independently wealthy just means that you don't have to work for somebody else. You don't have to trade your time for money. So that answers that question. How much do I need to invest to become independently wealthy? So you can look at it from either way. Let's start with the simpler one. How much income can I earn? Because you can kind of derive the independently healthy side if you just look at this one, right? So we're going to put in there $10,000. $10,000. And we're going to say calculate. And it's going to come down here and it's say, well, if you have $10,000 and you put it into any of these YieldMax funds, and we list all the YieldMax funds in here. All right, there they are. They're all listed. This is how much money you would make every month off of these particular funds. So if you take your $10,000 and you put it into TSYY, now we do have, looks like we do have some Granite shares, because TSYY is a Granite share fund. All right. So that's a Granite share fund. If we come over to TSYY, TSYY is right, it's right there. And see, Grok made a mistake. This says TSYI, and it's not. It's TSYY. We talked about that last class. That's a mistake. It's actually TSYY. So there you go, TSYY. It's the number one symbol It's an extremely high risk model, but it does return 143% annualized return. Can you believe that? That's just crazy money. All right, that's just stupid money. That's so much money. It's unreal. It's just like I can't believe it. Now, is it not going to return? The thing is we've got to take the gain into consideration as well. So 6-month gain, I think it's actually calculating this for the last 6 months, not the last year. So we've got a negative 32%. So it's dropping in value, right? So the gains are going down over the last 6 months. So if you subtract the gains from the yield, you get 111% return. So everybody looks at these funds and they're like, oh, I don't want to buy this fund. It's going down. It's gone down 32% over the last year. So you pull up your little chart, right? Let's go. Oh, it's right there. So you go pull up your little chart and let's do that. TSYY. You pull up your little chart and you say, well, this chart just goes straight down. I don't want to own that chart. I don't want to invest in that market. What a crappy market. Who wants to buy that market? Whoa. Who would want to buy into that market? Well, somebody who likes to have income. All right. It's an income generating market. So it's actually a pretty good market because it's going to return you 143% annualized return minus the 32% that it's losing in value, right? Because if we come over here and look, it's going down. It's gone down 32%. Over the last 6 months, it's gone down 32%. Before that, it was even bigger, had this big drop. All right. But right now, it's kind of stabled a little bit, but it's still just kind of slowly drifting down. And that makes it so you can buy the shares for less money, less expensive to buy the shares. So that's how they can return those big numbers, right? And so you can buy the shares right here. If you'd have bought the shares back here, you'd have had to pay $25 for each share. And you'd still make the same amount of money, the same return, because they give you the dividends down here. Remember, these dividends are the numbers that they pay out per share. And if you paid $25 per share and then got $1.38, well, that's a lot different than paying $10 per share and getting $1.38. Does that make sense? So as this market comes down, this is what they call NAV decay. But what they're doing is they're giving you back some of the money that you put in. So they're returning your ROC, right? Return of cash and return of capital. So they might be giving you some of your capital back. But that's okay. Then you get back to being a cash cow faster. Nothing wrong with that. Be a cash cow. All right. So then you come in here and you see, well, they're giving you, they went to 20, they went from monthly, which was back here, doing monthlies, and they switched. They decided, hey, let's do these things on a weekly basis and give the money out on a weekly basis. And it seems to me that once they did that, they kind of stabilized their net asset value a little bit. But they're giving you 20 cents every week per share, and each share is only $7.68. Now, you could do the math manually like we did before, right? Or you could just go over and look at that little calculator table, which did it for us. So you can come in here and you can do your little calculator and you can say, okay, well, I have $10,000 divided by the share price, 768. How many shares could I have? So you take your little calculator and you go $10,000 divided by 768, 7.68. That would give me 1,302 shares. And then remember that they give you this amount of money for every share you own every week. So they're giving you 20 cents. Last time they gave you 20 cents. So you go times 0.20, the number of shares. So that'd give me $260 on my $10,000 every week. Times that by 4 and you get your monthly income. That would be $1,000. So on TSYY, if you put in $1,000 or $10,000 every month, you're going to get about $1,000. So if you needed $3,000 to live off of to be independently wealthy, you'd need to put $30,000 into TSYY. Most people, when they think about how much money they need from the old method of doing the dividends, they would have to get, $3,000. They'd probably have to have nearly $1 million in the bank to get that kind of money. All right. Because that's talking about, with AT&T or something, or if you wanted to go off with Verizon or some traditional fund, or even, if you did it with Apple, you'd probably need to have $3 or $4 million to get the dividends that would be that kind of money. So these things are unbelievable. They're giving away stupid a lot of money. And now the reason is because they're not dividends. All right. You have to realize these are not dividends. These are premiums that are coming from options investors. So options is like an insurance policy. So what happens is, let's say everybody goes out to Tesla, right? because that's what this is. TSYY is based on Tesla. So if we go over to Tesla, and let's say you're just a normal investor in Tesla and you want to buy into Tesla, but you're really worried that Tesla's going to fall in value. Oh no, Tesla's going to go down. Well, what do you do to protect your holdings? Okay, you don't want to sell them, because if you sell them, then you have to pay taxes on them, right? So a lot of people won't sell their holdings because they don't want to pay taxes on them. So they don't want to buy low, sell high. So what they do is they come in with options. And of course, this is an opportunity for me to plug my next class down at the university. So I'd really like all of you to come and join me at the university in a couple of weeks. It's actually the first week in December where we do the options class, and I'll teach you all about options, because we can use options as insurance ourselves on our own TSYY or TSLY stocks. We can use options in there to help us protect our own positions. If you're worried about your NAV going down, buy an option. All right, because an option is what? It's an insurance policy against a falling market. Now goes both ways. You can buy options and make money when the market rises, or you can buy a put option and make money when the market goes down. So a lot of people will come in with these great big portfolios and they don't want to sell it out because they don't want to pay taxes on all their money. So what they do is they buy a put option, which is like an insurance policy against the market falling. Now, there's a premium for that. Anytime you buy insurance, you have a car and you buy insurance, well, you have to pay that premium. But if you don't crash, do you cry and complain and whine and bawl that, oh my gosh, I paid an insurance premium this month and I didn't crash to get a collect on my premium? No, you don't. You just, that premium's gone. You paid it and you didn't have to use it. And you're happy about that because you didn't crash. Well, these people are the same way. So if they buy a put option and they pay the premium to protect their portfolio in case the market crashes, and then the market doesn't crash, are they sad? No, they're not sad, because they got all this money. They own all of this stock, which is like their car, right? And it didn't crash. So they're happy and they paid the premium, but that's okay because it was just an insurance policy against a crashing market where they would have lost a lot more money, right? So that's what a put option premium is. So when people come in and they buy those put options, they're buying a premium, and that premium, that money goes to you over here in this market. All right. TSYY. So that's how you get this money right here. This money that comes into you, this 20 cents per share that you own, is because you are buying into an insurance policy. All right. So TSYY is like a big insurance company, and they sell insurance to people who want to buy insurance policies on their portfolio, on their Tesla portfolio. That's where the money comes from. That's how you can make this stupid a lot of money. Do you ever complain about your insurance policy premiums? You look at your premium and you're like, man, I got a little car here, and holy cow, look at the premium on my insurance. It's outrageous. I hate my high insurance premiums, right? I mean, look at health insurance premiums. Holy cow, who's making a bucket of money on that health insurance premiums, right? That's why the government's closed right now, because they're all fighting over who's going to pay the insurance company premiums. Well, if you're on the other side and you're making all that money on those premiums, do you want them to lower the premiums? Hell no, you don't want them to lower the premiums. Why? Because then you don't make all that money. All right. So you are the insurance company in this case. So if you put your money into TSYY, well, TSYY is the insurance company, and they're going to use your money to insure the traders on TSLA. And then when they buy their insurance premium, they bring it over here and they give it to you. Now, there is some downside to this. What happens if Tesla does fall? What if it actually does flush? What if you actually do crash your car? What if you actually do break your leg? Well, then you get to cash in on your insurance policy, right? And so your insurance policy gets cashed in on, and then the insurance company has to pay that. So if the market flushes over there, well, TSYY is going to go down too. Its net asset value is going to fall because you're going to have to take some of that money to pay the people who bought insurance premiums. So that's why you kind of have to build up your little portfolio here and then anticipate that there might be the possibility that the premiums could go down. It doesn't mean that they're going to stop paying their premiums just because they have to pay one out, right? I mean, if you're going to buy insurance and then you go to the car, you go to the repair shop and have your car fixed, does that mean you don't have to pay your insurance anymore? No, you still have to pay your insurance every month. You have to pay that insurance premium. But just because you collected on it this month doesn't mean you stopped paying your insurance premium. So that's what's happening here with TSYY. They may have to pay out some claims, right? They may have a few people who made money on their options over there in TSLA, and they have to pay out those claims. All right, well, we have to pay some claims, but it doesn't mean those people have to stop paying for their options premiums. They still have to pay for their options premium, and that money still comes in and still gets distributed to the owners of the insurance company, which is you. Okay, so you still get your premium, even though you might have to pay out some insurance, and that's what's happening here. So these markets are coming down, and as they come down, they have to pay out the insurance premium. All right, so somebody came to the company and claimed their insurance. Oh, my car wrecked, and so I need some money. All right, well, we'll give you some money, but we're still collecting premium. So when you come over here and you look at this little thing right here, this is how much premium they had to pay out. They had to pay out 32% of what they got that month. Now, they received 143%. All right, they collected 143% on their insurance policy, and that's coming into them every month. They're getting 143%, what they're getting on their premiums coming into them. Oh, but we had some claims. All right, how much claims did you have? Well, we had 32% claims. So we had to give back to the guys who actually crashed their cars 32%. But that still gave us, as the insurance company, 111% return on our money that month. Oh, poor insurance company. I feel so sorry for them. They had to pay 32% out. Oh, don't we feel sorry for those poor insurance companies who had to pay 32% out to people who crashed their cars when they made 143% on the premiums? I don't think so. All right. I don't have no bleeding heart for somebody making 143% monthly on their annual premiums that they had to pay out 32% on their claims. The 32% is the NAV. That's the net asset value. And that's what's wrong with these systems. All right. That's what's wrong with looking at the current model in the stock market. The current model doesn't understand that you're looking at an insurance premium here company. They think that you're looking at a dividend company like Apple, who shares a little bit of sparkly profits with you every 3 months to make you feel like, oh, I love my Apple. Oh, I love Apple. They're giving me some dividends. And that's what so if you go over to Apple, well, you complain if their stock goes down, right? Well, they give you a dividend. There it is right there. A whopping 26 cents on every $270 that you've got invested with them. Oh, I'm so excited. But they're not an insurance company. That's not what they do. So they don't have to pay out because they have claims. They pay out because they made a whole bunch of money, and then they shared a little tiny bit with you. Oh, you like our Apple? Oh, here's a little penny. Here's a penny. Apple is so skinny-hearted. You guys all know I think Apple's a worthless company. I like their products. I have lots of them. I just think as an investment, well, they've started to pick up here a little bit. Yeah, you can see they've made 3 drives here in the last 3 months. So they've made a nice little 3-drive pattern. But for the last year, they've just done nothing. Look at this. They're just worthless bums. And they've kind of picked up here. So they didn't participate in the AI race, right? I mean, this AI bubble that I don't think it's a bubble. That's another lesson for another time. But a bubble, why not? Let's talk about it. We're in the lab. That's what we do. We go off on tangents once in a while. So the AI, everybody's worried about this being a bubble. And I've been saying since the beginning, it's not a bubble. And why is it not a bubble? It's not a bubble because it's paid for. Now, there are a couple of companies who are borrowing money to do all this. And, Microsoft and OpenAI, which is ChatGPT, got together. And Microsoft is the one who's funded all of OpenAI. So even though OpenAI making a ton of money, they're not making enough to cover their bills, but that's okay because they got Apple or Microsoft over here who's got more money than God himself, and they have paid for everything that OpenAI has done. All right. So a bubble is when you build your entire investment world on credit, and then poop, they pop the credit bubble and the bill comes due and you don't have any money to pay the bill because it's all on credit. AI is not like that. Who's creating AI? It's all these giant, great big funds that great big companies that already have billions and billions of dollars sitting in the bank. So this AI development is all being paid for with cash. So it's not a bubble. So if you remember back when we talked about the dot-com bubble, right? Some of you lived through that. I lived through that. I was there. We were in business, running my business, a bunch of employees working through the dot-com bubble. Now, it didn't affect us because we didn't borrow money to create our .com. We built everything we did on paid for cash. I didn't go out and borrow a whole bunch of money to build my .com. I built it off of only money that we had. So when we had the .com crash, did my business fail? No, it didn't. It flourished. Why? Because we were paid for. We didn't have a big bunch of bills or big credit coming due. So that's what happened in the .com. They were all built on credit. There were no big companies with lots of cash that were doing this. They were all startups. And they borrowed millions and millions and hundreds of millions of dollars to build their .com, and then they flushed. They failed. So the internet didn't take off like they anticipated, and so the market failed. And that is why today, actually, believe it or not, that's why Track and Trade, the software company that I started, is a standalone application written in C++, and it's a very solid piece of software that's not built on a web browser like this is now. Web browsers have become more popular nowadays, right? But back during the .com business, anything you put on the web like this, those were the things that failed. You couldn't do it because it was too slow, right? The internet didn't have wide area network. You didn't have all the bandwidth. So nothing worked on the internet. You'd put all this stuff on there, and they developed the ability to put it on there, but this internet was so slow. There was no fiber optic cable to everybody's houses. There were no, Elon internet in the air. So everything came through little telephones, and you had little modems, and you'd dial in, and then nothing would work. So everything failed. I mean, they built all this stuff, and then nobody could use it. So that's why you had the .com failure. So we built our stuff, and that was kind of an emphasis. That's why you saw a lot of software programs come out at the time, and everything was built, you have to install the software on your computer because the .com failed. You couldn't do it. So everybody wrote software that wasn't on the internet. And so now it's getting to the point where you do have fast internet, and things are starting to migrate back over, and most of your applications are starting to be built on the desktop, on these browser versions. They're still not nearly as good. I mean, this is a neat little program, and don't get me wrong, FinViz has done a nice job with the little program, but it can't hold a candle to Track and Trade, which is a true desktop application that you install on your software, and you have so much more capabilities, and that all come from the .com failure. If you know that history, that's how that happened. They tried to put it on the internet too early, and it failed. And so everybody went to installed software applications, which were much better. And now we're getting to the point where you're starting to get some of these software, you kind of prefer them on there's some things that are they do really well on the internet, but if you get a desktop version of it, it's way better. All right, because that's just the nature of the beast. And that's why we had a .com failure. But they did it because they were all on credit, and then it failed. The technology wasn't there, and they failed. But now we're doing AI, so the technology is there. So we do have the infrastructure, and we've also got the companies who are building it have billions of dollars sitting in the bank. So when you go over and you say, well, we're in a .com bubble, not really, we're not, because everything's paid for. Mark Zuckerberg has billions of dollars coming into him from Facebook, and he's just using his profits to build AI. So it doesn't mean that if AI fails, Facebook fails. No, Facebook's a very successful business. He's making a ton of money on it. And so he's got all this money coming in to build AI with. So even if AI failed, you're not going to have a failure of Facebook. Facebook's not going to fall. Same with Microsoft. Microsoft's spending billions of dollars on AI. Well, if AI fails, which it's not going to, who's going to give up their AI? Anybody who uses AI now knows that nobody's going to ever give it up. I mean, if they came to me and said, Lan, I'm charging you $20 a month for your AI system, and it's going to fail if you don't pay $40 a month, I'd whip out my wallet faster than you could see my hand move to give them that $40 a month. They could double their income like that, because there ain't nobody who's going to give it up. Once you start using AI, oh my gosh, your life has changed. You will never want to go back. It's just crazy good. It's that good. You would pay 3 times. You would pay 10 times what you're paying for it right now if you're in business for 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 what it does, because it's so effective. All right. So the .com bubble is not a .com bubble. I'm not worried about a failure. Now, does that mean that markets can't pull back? No, certainly. Of course they can. Why do markets pull back? Well, they pull back because people want profits. All right. They make a whole bunch of money. The only way you make money in these markets is buy low, sell high. So you buy low, you sell high to get your money out. And when you sell, the market goes down. And when you got great, big, huge, giant firms that do this for a living, that's how they make their payroll. They have to sell some so they can make their payroll. And so that's how these great big hedge funds, that's how they distribute money to people who want to live off their income. They have to sell. All right. So they buy and sell. And that's what causes a market to go through waves. Right. That's why we call them 3 drive patterns. See that? Drive 1, drive 2, drive 3. Well, people are buying and then they're selling, and then they're buying and then they're selling, and then they're buying and then they're selling. And in the process of that, over time, if you go back and look over a long history of time, there's a monthly chart. Well, markets go up and down because you have bigger firms buying and selling, buying and selling, buying and selling. And of course, then the federal government has to get in and meddle with it. And the Fed goes in and changes interest rates. And they dilly-dally around and fiddle around with stuff. And it all has to do with world economy. And markets go up and down. But for the most part, over time, markets go up. All right. If companies are doing well. Now, this is Apple, and they've been doing well their whole life, but it doesn't mean they don't have bad times, right? There's some bad times economically, but for the most part, they get that stuff figured out, and they buy low, sell high, buy low, sell high, buy low, sell high. And that's how the market works. So does it mean it's going to be a .com failure, or does it mean it's going to be an AI bubble, and oh no, the world's going to collapse because we're going to end an AI bubble, and so everybody should take all their money out of the market and not invest in the stock market? If I had a nickel for every time I heard that throughout my 40-year career of doing this, I'd be rich, rich, rich beyond my wildest dreams just off the nickels. There are naysayers and anti-market people out there every day, just like you would have Republicans and Democrats. Half the market people think the market's bullish, half of them think it's bearish, and they fight like a football team out of Chicago, right? The Chicago Bears against the Who's going to be if you got the Bears, who's going to be the Bulls? That's a basketball team. Anyway, I think you get the point, right? Have I driven that home yet? All right, let's come back and start looking at some of these things. I saw down here, Dennis is asking what the calculator address was. Where did I put that? It was in here somewhere. Oh, it was on the slide, wasn't it? It was on the PowerPoint. There it is, Dennis. So just go ahead and take your little iPhone and scan that. If you got a little phone like this, most guys have these. Dennis, do you not have one of these? Of course you have one of these. Go to the little camera, pull up the little camera, right? And then just point the camera at that. And then that'll pull up a little link on your phone, and you can touch that little yellow thing. Don't take the picture. That does not do you any good. Just point it at it, and then it'll take you to the page where the calculator is. And then the calculator is actually, once you do that, the calculator will actually be part of that course. I think we're in here. That is just the calculator right there. You can see it in the URL up here too. It's pitnews.com/dividend-calculator. Okay. All right, so let's get back to what we were doing. Let's come in here, put our $10,000 back in here. Go into calculate. All right, so there's your fund. That's TSYY. And so that's how this works. So what this does is it shows you a list of all of the funds. And it looks like I got Granite shares in there, at least some of them. Some of the Granite shares and all the Yield Max funds. So you can see, let's come down here. This is winter. And that one's for that's if you think that Bitcoin is going to go down, which it has been for the last year. You put your money into WNTR, and that would be an insurance policy that the people are buying. You'd be the insurance company saying that they're buying insurance policies for the market going down. All right. And so The premiums are coming in at 104, and they haven't had to pay out any gains. I don't think that's right. So that calculation is missing something. So there's a couple of these in here, which are the short ones, and I just ignore all the short ones. I don't like any of those. Okay, now MARO. Well, I don't want to talk about that one either. Here's the next one I want to talk about. Tesla, TSLY. This is, again, another one like this one here. So this is TSYY by Granite Shares, and they use put options to make their premium. So they're selling put options for people who want to buy put options. All right. That's what we talked about. That's an insurance policy to protect traders if they think the market's going to fall, and they're collecting those premiums, those insurance premiums. TSLY, this one here, now remember, YieldMax does something different. They anticipate a rise in price, so they buy what we call synthetic long positions with options, which is mimicking ownership of the stock, but it's what we call a free trade. So they don't have to actually buy the stock. They're not buying the stock, but they are anticipating a rise in price. But then they don't think that it's going to go really high, so what they do is they sell a covered call to collect the premium, and that's where they're getting their premium. All right, that's their insurance policy. So they get a premium paid off of that insurance policy that people want to buy. And again, shameless plug for my options class. I'm not going to go into because this is a little bit more complicated, more sophisticated strategy. Buying an insurance policy if the market falls, that's an easy one. That's what Granite Shares does. They're just selling put options, all right, for people who think the market's going to fall. TSLY, which is coming from YieldMax, they're a little bit more complicated. It's the same concept, exactly the same concept. They're just using a different strategy. So they think the market's going to go up. So they actually make more money if the market rises in value. Now, they don't make, if the market rises in value and goes a whole lot higher, well, they don't get to capture that top part because they cap it with collecting premium, insurance premium. All right. Again, we'll go into that in greater detail in the options class. Show you how that's done, and you can do it yourself in your own market. So I mean, if you have a bunch of stock, you can do this yourself, and I'll show you how to do it yourself. It's not hard. You just have to understand the concept. All right, so that's what YieldMax does, kind of a different strategy than Granite Shares. So we're going to come in and look at Tesla, but you can see nonetheless what we've got going here is Tesla, because the market's been going straight up, they've been collecting premium, right? They've been collecting their insurance premiums at 101%. That's pretty good. Not as good as the put options, because what happens when the market gets really high and overextended, lots of people buy more insurance policies in case the market falls. That's why TSYY is doing really good right now, all right? Because they're selling a lot of premium, lots of insurance for people who think the market's going to fall to protect their portfolio. That's why they're on top of the list right now, because Tesla is really high. But if Tesla was lower and it wasn't looking like it was going to fall, TSYY wouldn't do as well, because people don't need insurance if they don't think the market's going to fall, right? If the market's not really way up high, they don't think the market's going to fall, so they don't buy the insurance, so TSYY wouldn't do as well. But right now, TSLY has been going up, and so TSLY gets to profit from that. So they haven't been having to pay out anything. In fact, they're positive, all right? They're making money where TSYY is losing 32%. See that? They're losing 32% because they have to pay out their premiums. Well, TSLY, because they have a different strategy, they're not paying out any premiums. In fact, they're making money, 119. So you get to add those two together. They're the premiums they're receiving plus their 119. They're not paying out anybody's not losing money, so they get to keep that. So they're getting 102 as their total income that month. And they get to share that with you. That's what they're sharing with you. You get to make 102. Now they're taking their lump of flesh out of that too. That's how they make money, is they take 1% of everything that you make. So they give you 102%, but you actually made 103%. But they took 1%. That's why you only get 102. All right. So it's already taken out. It's invisible to you. You don't see that. That's their premium. So this is showing you what you get. All right. 102. They've already taken their chunk of flesh out. So 102 is what you get. Okay. So let's go down to another one. That's a Bitcoin. There's AMD. I have some of this one. I told you I'd show you my portfolio. I have this one. I have this one. I had some of this one, but I switched it. I traded it out for this one. And it looks like I would have been better off if I'd have kept it, but I put it over here into this one. But This one's good, obviously very good. And just because I sold mine out doesn't mean that you can't buy it. You can certainly do anything you want. Like I said, this is not a religion. We're not, uh, you know, we're not into yield max just because, oh, Land loves yield max. Well, I love yield max because they trade options the way I traded options. And I traded options this way too. I traded the way these guys do it too. That's a very popular, common way of trading options. I did a lot of that too. So when I heard that Granite Shares was doing it, I was really excited. I was like, oh wow, that's the way I trade options too. And Granite Shares is going to do it for me, much more sophisticated strategies. So why not? Heck, I'll let them trade my money for me. There's BABA. I don't have that one. NVIDIA. There's another good one. Look at this. So NVIDIA, they are receiving 100% in insurance premiums, but they've had to pay out 7% in payouts. All right. So that means that they're making 93%. They're still very high on the risk. Okay. So now you can come over here and see the dollar amounts, and these dollar amounts are important too. So this is where you're going to see, well, how much do I need to become independently wealthy? Well, on a monthly basis, this TSYY on $10,000 is calculated to be about $1,100, or in a year, $14,000. So if we come down and we say, well, I want to go into AMD. Where was AMD? AMD has a little bit, it's still very high on the risk, but it's lower, a little bit lower. All right. But they're AMDs, they're this is insurance policy that they're selling on AMD. So they're collecting 101, but because AMD went straight up, they didn't have to pay out any insurance premiums. So they got to make $44.94. So when you add the 101 premiums that they received, plus they didn't have to pay any premiums out, right? Nobody had to collect. They're making 146% on their yield plus their gain. That's higher than at TSYY. Right? So this is sorted by yield, but yield plus gain, because if they didn't have to pay out any insurance premiums that month, look at that. They got 44% on their 6-month gain for 146% return. Isn't that unbelievable? NVYY is the Granite Shares one. NVDY is the yield max. Yes, correct. Paul Gooddown is clarifying. Okay. So they're different companies that do different strategies. So you can kind of think about that too. It's like, well, which strategy, which company do I want to buy? Do I want to buy TSYY from Granite Shares, or do I want to buy TSLY from Yield Max? You can do a little of both. Nothing wrong with sharing, right? But remember, TSLA will make money on the way up and less money on the way down. TSYY will make less money on the way up, but more money on the way down. So they're good partners, because this one's put options and this one's call options. All right. So now we come down. There's NVYY. NVYY, I think Paula was saying NVYY is Granite Shares. That's the Granite Shares one. And NVDY is the, and where's that one in here? Is it, we got it in here in this list, NVDY. It's way, there it is, NVDY. So NVDY, which is the yield max, which is the call option version, is making 40% on the premiums that they're selling. And they didn't have to have any claims against them. So they made 13% on that. So they're making a total of 53%. So NVDY, which is the yield max version, which is using call options, made 53%. And Paul said NVYY is way up here. NVYY, where did it go? I passed it. NVYY was in here somewhere. I can't see it. I thought it was up higher. NVYY. There it is. NVYY is making 100%. Now they did lose 7%. They had claims against them of 7%. All right, so they had to give back 7% of their 100% premiums, but they still made 93%. That's crazy money. That's crazy money. Crazy money. All right. So as you come down here and you get down here, so these are all, they're all very high risk, as you notice. These are all very high risk. All right. We come down here, these are just high risk. And then these are moderate risk. And then these are the low risk ones. All right. Low risk ones, they don't make very much money. All right. 10%, 12%, 30%. That's still, you know what? In the world of dividends, 10%, 12%, 30% is unreal money. That's like huge. And in this table, we look at those, and those are the low to moderate, and those are the ones we're like, oh, I don't want to invest in that. It only makes me 30%. I don't want an old rotten thing that only pays out 30%. You know how long, if you took your money down and put it in Cash Valley Bank in a bank CD, how long you would wait to make 30%? 5, 10, 15, 20, 25, 30. You'd wait 6 years to make what these guys are going to do and give you in 1 year. 6 times more money. And that's one of the worst ones on the list. It's one of the worst ones on the list. Now you got YQQ, who's actually losing money, 8%. So I got the question last night, Boost Crate, are you here today? Boost Crate? He asked me last night in class, he says, well, how do I know when it's time to get out of a market? Well, you can tell which ones to get out of because this number goes negative. If that's negative, well, you're losing money. All right. Probably not a good investment. So they're getting they're selling options and they're collecting a premium of 17%, but they're having to pay out 26%. So they're getting a lot of claims against them, and their premiums are not high enough to make them any money. So they're losing 8%. So not a good insurance company. YQQ is not a good insurance company. Don't buy that one. All right. Here's another one. Looking at dips. NVIDIA. Now this one, dips, is actually if NVIDIA falls. All right. So it would make money if NVIDIA falls. Well, NVIDIA is going straight up like a stock on Viagra. All right. There's no dips in that one. There are no buy the dips. Okay. There ain't no dips. So NVIDIA, they're collecting 38% on the premium that they're selling, but because the market's going straight up, not down, and it needs to go down to make money, they're losing. People are claiming 50% against them. They crash in their cars. So the insurance premium that they're covering is for the market to go down, and the market's going up like a rocket ship. So that's why they're losing on the gain. So that means they're losing 11%. Now, if NVIDIA fail, this would reverse. This premium would go shoot way up, right? And this would go way down, and they would be making a whole lot of money. But NVIDIA would have to flush like a toilet for this to become profitable. But if you're worried NVIDIA is going to flush like a toilet, this is the insurance premium you'd want to back. That's the one you'd want to do. That's why they have these short ones. All right. If we come up to the top, I kind of told you I ignore the short ones. This was the Bitcoin one on MSTR, and that's a short. Well, they haven't got a number there, so I'm not sure what it is. So this one is Coinbase is one. This is okay. This one will make more sense for us. Tesla, TSMY, is an insurance policy to the short side. Well, it says the underline is TSM. I'm not sure what's going on there. I thought that was TSM. Oh, this is Taiwan Semiconductor. Okay. But look, this thing's going straight up like a rocket ship too. But let's come over to a daily chart. Okay. So it looks like it's topping out, starting to go down. Anyway, where is that at? Where did we go? Here we are. So we're at Taiwan Semiconductors. All right. So TSMY. Oh, that's a long one. That's not a short one. Excuse me. It's making money hand over fist too, because it's going straight up, just like NVIDIA. But you're getting 105% on the premiums that they're receiving, and they haven't had to pay out anything, so they're making money over on the gain side too for 123%. That's just unreal money. It's just crazy, ridiculous. All right, Morrow. What's Morrow? MARO. Yield max, Morrow options, income strategy. Maro. M-A-R-O-M-A-R-O. What is the underlying for Maro? Maybe it's one of these. Let's come down and see what it's invested in. Mara. Okay, let's go see what Mara is. Mara Holdings. Not a very good stock. It's just going straight sideways. It's a financial stock, capital markets. Kind of a dead market. I don't know. They don't pay dividends or anything. They've had good earnings. They had really good earnings, but the stock's coming down. Look, it's not been going up like the others. I don't know. It's not doing very well. Or actually, it's doing pretty well, right? Maro? Yeah, it's doing pretty well. 104% Maro is what they're collecting on their insurance premiums, but they had to pay out 21%, so they're making 82%. 82% is still killer. I mean, that's just stupid money. Stupid real money. And this is the AMD, 146%. So they're collecting 101 on their premium. They didn't have to pay anything out because it's going straight up. They're making 146% right now. 106, 93, 80, 96, 51, 37. They get smaller and smaller as we go down the list. That one's still pretty good. Oh, that's Hood. All right. How many of you guys have Robinhood as your brokerage firm app, right? Your little brokerage firm app on here, little green one. So if you got Robinhood, you can trade that company on the stock market. And so that's it right there. Robinhood, Hoy, Hood. Let's go look at that one. So you pull up Hoy. Well, let's look at Hood first. So this is Robinhood themselves, and they've been going straight up, just like crazy. But they're topping out up in here, just like all the rest of the stock market. And we're in for a drawdown. If you guys are not ready for a drawdown, gird up your loins, because I think we're going to get a pullback. I've been thinking we were going to get a bigger pullback back in here. I thought this was going to be a bigger pullback, and it was going to pull back to these 50% level, that little line in there I've got drawn. It didn't. It took off and went again. But I think this time we will. I think we're going to we're in for a drawdown. This market's been just going straight up. We're in for a drawdown, profit taking, right? But that's good for us. So they're going to still collect their premium. They might not make as much money they might have to pay out some of this. This might go down. But this is going to stay still making about that same amount because they're going to sell their premium. They're going to still collect their insurance policies every month. But this is probably going to go down if Hood goes down because that's their net asset value, right? That's the growth. But they're still going to make, they're still 87%. So even if they lost the entire 30%, they're still going to be making almost 60%. Does that make sense? So if you're worried about a market flushing, these are the markets you want to be in. Okay, because they're going to still collect their premium. They might not make as much on the rise, but they're still going to make their premium. And so that comes and brings us over to the next calculator. So let's come over here. And we're going to go up to the next calculator, the break-even calculator. Now, if you come over here and we're going to go down, we've been using Tesla. So let's go pull up Tesla again. TSLY, TSYY, TSLY. Let's just do TSLY. All right, this is the Yield Max Tesla Fund. This is the one I have. And so you can see how this is set up. So the way this little calculator works is it tells you if Tesla falls and it loses money, right? So if you own Tesla, the stock, and it goes down, you lose money, right? That's the nature of the beast. You bought it for $100, it went down to $90, you lost $10. So that's what this calculator shows. So it says, okay, well, what if I own TSLY, not TSLA? I didn't own Tesla. I own the Yield Max TSLY insurance policy version. They're continually receiving the insurance premiums, even if the market goes down, right? So you have the yield, the insurance premiums, and you have the growth, which is the net asset value of what they have to pay back. They have to pay back if the market goes down and they have to pay those premiums out. So this is a calculator that shows you how much right now. It says for 1 year, all 12 months, Tesla, we have $10,000 in there, made absolutely nothing. You bought it for $1,000, and at the end of 12 months, it's still sitting at $1,000. You made nothing, zero. All right, does that make sense? Everybody's on board. But what did TSLA do during that same period of time? Well, not TSLA, TSLY. What did TSLY do at the same period of time? There it is, cash out. If you just took every single penny they gave you, it did this. All right. $19,829. So it went from 10,000 to 19,000. You still made $9,000 in a market that underlying Tesla went to zero, or didn't go to zero. It made nothing. For the whole year, Tesla made nothing. Well, your TSLY still made $9,829. And if you would have done the drip or reinvested every single thing, every time you got a dividend, you put it back into TSLY, it would have been the green line up here. It'd have been, you'd have made $25,981 on your $10,000 investment in 1 year if you'd have continually reinvested. So Tesla itself can do nothing, go flat nothing, and you still make a ton of money because you're the insurance policy. You're the insurance company. Tesla went sideways, so nobody made any claims on their insurance policy, right? They didn't make, the company didn't make any money on their growth. There was no growth. But because they're collecting insurance premiums every month, they still made $25,000. And if you didn't reinvest it and you just lived off of it, well, you made $19,000. So you put $10,000 in, you made $9,829. You almost doubled your money, and the market went nowhere. That's pretty cool, right? These are pretty cool markets. They're only brand new. They've only been around for 2-3 years. Now, why have they only been around for 2 or 3 years? Because it's not that this is something new that you couldn't do beforehand. You could do it yourself. Like I said, I've been trading options forever, and this is how I've traded my options, the same strategy. The thing is that on an institutional level, which is what this is, right? We're giving an institution our money so that they can do this. It's always been reserved for the big banks and hedge funds. They've done this insurance policy stuff for retail traders, and they've never brought it to the retail trader and let them participate. This is how these big banks, hedge funds, and great big huge money managers have been making money hand over fist for 200 years. They've been doing it and not letting us participate unless we would do it ourselves with our own portfolios, with our own options. They've never done it for us. They've just done it themselves. They've hoarded it. Little buggers, little sneaky bastards. All right. So finally, these companies, well, YieldMax being the pioneer, came out and said, you know what? We're going to do this for the retail trader. We're going to let them participate in this, something that only big institutions have done for 200 years. It's true. So that's why it's available now to us just within the last 3 years. And it's just coming out, and that's, everybody's jumping on the bandwagon. That's why you're getting all these companies that are starting to do it, because they've changed the rules and now they can do it for us. All right. Let retail traders have it, not just the big institutions. This is how big institutions have made money forever, selling premium to buyers of options. We buy options to make money, but if you wanted to sell it, you had to sell it yourself. There wasn't an institution that would do that for you. Now there is. Okay. So let's come in here and see this little slider. This little slider is really cool. So now you can say, well, what if Tesla didn't lose, went to zero? It actually made some money. Let's say Tesla made, let's say it went up 25% over the year. That's been a good run for Tesla. Now Tesla sometimes goes higher, but let's say that Tesla went from you bought it for 1,000 and it went up 25% in 1 year. That's a lot of money. You happy about that? Heck yeah, happy about that. My Tesla went up 25% in 1 year. I'm rocking and rolling. Okay, well, this red line represents Tesla. What happened to your TSLY? Well, it gets to go up too, because they didn't have to pay out any premiums, right? And it went up. And so now you went up too. So now you went up to 22,000 on this one. You went up to 30,000 on that one. Tesla went up 25%. So you'd have to do that math to see how much that was. Well, it's actually done right here for you. TSLY, TSLA value, 12,500. So if you went up 25% on your $10,000, you made $2,500. But the gain on TSLY was $20,000. And your gain, if you cashed out, was $12,000. If Tesla went up 25% in 1 year. What if Tesla went up even higher? What if Tesla went up 40% in value? Well, now you can see that your TSLY would have made $23,000. Your TSLY, if you would have cashed out and just taken all the money and lived off of it and not reinvested any of it, would have been $14,000. And Tesla itself made $4,000. 40% gain on a $10,000 investment is $4,000. Look how much more money you're making. Now let's go the other direction. Let's go all the way to the top. Let's say 50%. So let's say that Tesla made 50%. Well, Tesla made a $5,000 gain, 50% of their value. 10,000, 50%. That's how much Tesla made. Well, TSLY, if you'd have reinvested all of your dividends, you'd have made $35,000 in the same period instead of $5,000. Because you're not only getting the growth, you're also getting the premiums, the insurance policies that people are paying. Now, that's in a perfect world, and we know it's not perfect, but if it goes up and down over a period of time, that's basically what the structure is. If you cashed out, you'd have been able to cash out $25,000, actually $15,000. $15,000. So over a 1 year period of time, if Tesla went up 50%, you'd have been able to get $15,000 out of that market, whereas Tesla itself only made $5,000. You got $10,000 more because you got $10,000 in premium, plus you got the $5,000 in growth. That's nuts. All right, so let's go down. Let's say that, now where does it go? The little slider doesn't go far enough for the red line to go above the green line, but it will. It will eventually go above the green line. I probably tell Grok to make this go to 100, 200, 300%. Because if we could stretch that out to 300%, well, then that's when the red line goes above the green line. So there is a point where Tesla will make more money than the underlying, than these yield max funds. But it has to go, but Tesla would have to make like 300% in a year or something like that before it's going to surpass the value of what TSLY is making. That's crazy, right? How often does Tesla go up 300%? Well, it does. Tesla has a tendency to make those types of runs. So do some of these other, Palantir, so does Hood. I mean, we talked last night, Robinhood went up like 400%. So did it make more money than the Robinhood underlying TS hoodie? It did. That's at that point. There's a point in there where the red line will go above the green line, but it's way out there. And the chances are, what's the chances that a company's going to make 400% in a year? It's pretty low. They don't do it very often, but on occasion they do. So could you have made more money in that example if we had to put it in HOOD? Yeah, of course you would have. It was 400% increase in value. It would have made more than the underlying Tesla fund. But did you know it was going to go up 400%? Who would have thought that Tesla itself would have gone up 50%? Right? There is a point where it outperforms the insurance policy company, but it's got to be a lot. Let's go look at HOOD, see if it's in here. It should be in here. See if we can find it. Oh, these are in alphabetical order. A, B, C, D, E, F, G, H, H, H. There it is. So there is the little hood. That's the Robinhood program. So if Robinhood did nothing, went from you put 10,000 in at the end of the year, 10,000, the Hoy would have got 7,000. And if you would have just taken the money out and spent it, you'd have made 5,000. That's pretty cool. Can't complain about that. All right. So you made 55%. Well, Robinhood made nothing. But that's your insurance premiums that are coming into you every month. If you had to pay some out, let's say, we were going to go the other direction. Let's say that the market goes down. All right. So let's say Robinhood lost 50% of its value. You put in 5,000 and you lost $5,000 because you hung on to it and it went down for the whole year. You lost 5,000. Well, if you owned HOOY, you still made $2,280. You still made 22% return on your money. 22% return on your money, and HOOD went down 50%, lost half its value, and you still made money. This is why I have right now, I have nothing. I have no money in the stock market. Zero. I have zero money in the stock market, meaning that I have not put any money into any long stocks right now. Why? Because the market is like, it's on fire. It's like way up there. It's like, look at the SP. Why? It's like, look how high the S&P is. Now, I haven't had any money in the stock market since about right here. I took it out when it made the top of the 3-drive pattern. Those of you who know me, you know technical analysis. Technical analysis is kind of my specialty. That's kind of my expertise. That's what I've studied my whole career, is the mathematical modeling of the markets. Okay, so that's kind of where I shine, and that's another shameless plug for why you should be in my next class. All right, the one it's touted as day trading, because we do a lot of technical analysis in day trading, but we also do a lot of technical analysis in long-term investing too. So to learn how to use all these indicators and how to use all the mathematical modeling, you want to learn technical analysis. I teach that class. That's the next one coming up. I take a week break. So next week we're off, no class. But then after that, we start up and it's 3 days. It's Monday, Wednesday, Friday next week. And so you might want to take that class so you can learn some technical analysis. So right here, I got out. And then the market went 3 more drives, which is just like, oh my gosh, this thing's on fire. All right. And so this thing is absolutely on fire. So I got completely out of the stock market right here. I don't have any long positions, but I have all my money in all these yield max, and well, mine are all in yield max right now. I don't have any in the Granite shares, and I probably should, because Granite shares is a better protection if the market falls. So I should probably start putting some of my dividends that come into me into the Granite shares, because it'll be better protected. But if the markets, let's say that I'm in HOOY, which I am, HOOY, right? And it drops 50%. Actually, I'm in HOOY. I'm not in HOOD, because HOOD is the stock market. I'm not in the stock market. I'm in the insurance business. I'm in the insurance company business. I am insuring people who think the market's going to fall. Problem is, I think the market's going to fall. So I'm going to still collect the premiums, but I'm on my little calculator. If the market goes down 50%, I'll still make my premiums. I'll still make 22% if the market drops 50%. I'll still make 22%. I'm not in the red line. I have nothing in the red line right now. I've taken everything out that I had in the red line, and I only have it in the green line and the blue line. Because, well, I'm not taking much out and spending, and I make more money than I need to live. So I haven't been taking any out. I've just been putting it right back in again. So all my money is in the green line right now. I haven't got any money on the red line, because sometimes I do. Sometimes I like to have some money in the red line, right? What if it does go above the green line? Well, I want some of that. All right. So sometimes I do put money in the red line. But all my money right now is in the green line. And that's the reason why, because I'm worried the market's going to do this. And if the market does do that, I'm in the green line. Not such a bad place to be, right? All right. So that's how it works. Now we come over to the dividend calculator. And this is the part that we use, that we just can use to compare a couple of markets against each other. So let's say we're going to come over here. Actually, let's come over to, let's do the, we got to use a piece of paper with this one. All right, got to get a piece of paper, and we're going to go back over to this one, and we're going to compare two. So we're going to put in $10,000, and we're going to go calculate, and we're going to come down here and we're going to compare. Let's compare TSYY as of today. So we're going to write in TSYY, write down the symbol, and we're going to say that the yield on, actually, this is not the one, because these math's already done for us. So we're going to show you how this little dividend calculator works. What we do is we're going to come over here, and we're going to go TSYY. So we're going to compare TSYY against TSLY. So TSYY is currently trading at $7.50. So write down the share price and write down the most recent dividend that it paid out. Paid out 20 cents, 0.20. So see how I wrote that down? Just wrote that down. That's all it is. Those two numbers. And then we're going to go over and we're going to pull up the same thing. We're going to pull up the two numbers, TSLY. And we're going to write down the same thing. So this one is TSLY. And it's currently trading at $8.22, $8.22. And the most recent dividend it paid out was 14 cents, 0.14. I oftentimes like to look back 4 of them because the whole month, that's 11 cents. This one is 16 cents. This one was 19 cents. So you add all those together and divide them by 4, and you're going to get the monthly return because they're a little bit different each time, right? So if you just take this one, you might just hit the low one, which is 14. Well, they did 11. That, 11. This 16. That was a lot better. 19. So if you take those 4, add them together, divide them by 4, you're going to get an average of the 4, which might be a little bit more accurate. So if we'll just take 14 though right now. So we'll take 14. And now what we're going to do is we're going to go over to our calculator and we'll go into dividend calculator. And in the first one, I'm going to put in here, I got the information written down. So TSYY. And then my share price is $7.50. And my dividend amount is 0.20. And it's paying out weekly at 0.20. So I have to change this to weekly right there. Now we're going to come over here and we're going to put in TSLY, and the number of shares is 8.22, and the dividend is 0.14. And it's paying out weekly now as well. All right. And we're going to put in $10,000 and we're going to calculate. So now you can come down here and you can see those two comparative. See how cool that is? This is a free calculator to you guys. All right. So we're going to come in here and it's 138. Now these are going to be rolled over, eventually going to be rolled over into portfolio matrix. So these are the kind of some of the preliminary tools that we created for everybody. And then we're just like, well, let's bring it all, the spreadsheets and all the calculators, and we'll put it all into one roof and we'll program it all into one fancy little program for everybody to use under portfolio matrix. So right now this is here, and eventually this will be rolled over into portfolio matrix and it'll no longer be here in Pitt News Magazine. All right. So you got 138% on the TSYY. So if we compare, well, TSLY is at 88%. Weekly, you're going to get $266. Weekly, you're going to get $170. So with reinvestments, a week, you're going to get 3. It's over a year's period of time. I don't think that's right. With reinvestments, it says you're going to get 300. This says you're going to get $35,000. I think something's wrong off on that one. That doesn't seem right. 266 versus 170, and this is 3,000, and that's 35,000. I'm going to have Grok look at his math. So I think this is correct though. 138.88. Weeklies 170. This is 266. Monthly 738. 1,155. Yearly 8,000. 13,000. That all sounds right. 5 years 44.69. 5 years 54,079. So in 5 years, if it would maintain this rate, which it's going to fluctuate, it doesn't always go up and down. Let's do this one up here. In 5 years, if you put $10,000 into TSYY, it's saying that you'd have $80,000 in 5 years. That's without reinvesting. It's saying with reinvest. If you put your money back in, and I get that's 170, and you reinvest, that just doesn't make sense. This would be 35,000 and this would be 3,000. They're not that far different. 170. I don't know. I have to do the math myself, but it might be right. I don't know. I would say that you're making $9 million. It's just unreal stupid money. It's just, now you know why insurance companies have so much money. But that's the name of the game. 138% return on TSYY, 88% return on TSLY. Both of those are making money off of Tesla. TSYY is selling puts, so they're collecting premium if the market goes down against people who think the market's going to go down. And premiums right now are really expensive. They're very expensive because a lot of people think Tesla's going to fall. So the premiums have gone way up. That's why this is so high right now. All right. These guys are making money if the market rises. And a lot of people don't think the market's going to rise anymore. So that's why this is starting to flush down a little bit. Okay. But still 88% is still unreal money. It's just like, that's a lot of money. That's a lot of money. All right. So some of my students, some of my friends and my students that I've been teaching, we've been putting them just to get started. They don't have they're starting off with a small amount of money, $500 or $1,000. I put them into this one, TSYY, because they get to see a lot of money come in. Right? It's nice. And when your very first investment, you get to see a lot of money come in every week, and that's fun to see. So that's a fun one to have. So if you're just starting out, that would be a fun one to start with. Just put $500 in that and watch every Friday. You're going to get a big paycheck. All right, guys, that's what I had for you today. And if you have any questions, last time there were some questions that were asked, and I didn't see them, and I hung up the phone before it was over. So Dennis is saying, so if the green line goes up, even when the red line goes down 50%, then where is the risk of loss? The risk of loss is in the, well, because you're collecting premium, the risk of loss is that they have to pay the right, because they're selling an insurance policy. So the loss is if it goes down more than 50%, just like if it goes up more than 50%. So the thing about these funds, let's go over and look at that loss calculator, the break-even calculator. You say, well, where's the risk? Well, the problem is this little calculator only goes to 50%. I need to make it go wider. It needs to go up to 100% on each side. So you could make 100% or you could lose 100%, which is pretty unrealistic. I mean, most markets they're not going to go to zero. I mean, they might. I mean, you know, we could get a nuclear bomb and everything goes to zero. So at that point, it doesn't matter anyway, right? But this little calculator only goes to 50%. So Dennis is asking, where's the risk? It's like, it seems like there's no risk in this. Well, the risk is if the market goes below 50%, this will eventually come down and lose money, right? I mean, it's not making as much money at zero. It's making a lot of money at zero. It's making a whole lot more money at 50. But if it goes below 50%, then this green line will go below zero and you start losing money. That's the risk. But this is at this current rate. Now, remember, these markets are dynamic. They will shift as well. Because if the market starts to flush really hard like this, then the insurance premiums might not be as big. Or they might get bigger, actually. But you know, depending on what you have to pay out in the premiums. So this is assuming that the premium stays the same and the net asset value, the NAV, goes down. So the premium, technically speaking, if the market started to flush like that, well, yield max is going to suffer the worst in a big flushing market. Yield max is going to suffer worse because they make more money when the market goes up than they do when the market goes down. Okay, they have a big investment in the market going up, whereas Granite shares would actually be better off because they have protection to the downside because they're using put options. So the risk is in that this little slider doesn't go far enough to show you the losses. But you'd have to have some pretty nasty losses for these markets to lose money because mostly they're just insurance premiums. They're just collecting premium. All right, let's see what else. Hoy. Hoy is the put option stock from Granite. Yeah, we got that one. Oh, did you want to see that, Paul? Paul saying Hoy is the one Granite Shares is doing for Hood. So if we come over here, you want to do one more? Should we do, what did we do? We did Tesla. Let's do Hoy. So we'll compare HOYY, which is the Granite Shares Robinhood. So let's write that down. And this is brand new. And that looks like it flushed out hard. Now, usually that's what we see. When these markets first come out, we usually see a big flush. This is flushed, but it's not as big as it looks. It's all scaling, okay? Because it's only gone from $26 to $21. So it's only flushed $4. And yeah, that could be a pretty good flush, but it's not as bad as it looks. It's more like this, all right? It's just that when you're in a software program, you can scale it and make it look as bad as you want. Oh, look at how bad that thing flushed. Oh, it's awful. Oh no, I guess it didn't flush that bad. Oh, it didn't flush at all. You know, it's scaling. So you have to make sure you look at the dollar amount, how much it scaled. So it's went to 21 from the very high peak at 26. So it dropped $4. Percentage wise, from 26, that's a pretty good little percentage, but it's not as bad as it looks. All right. So it's at 21. 2108. And remember, it doesn't matter what you paid for those shares. You're still going to get your dividend. The thing is that the lower the share price, the better the percent return of your dividend on your investment. But if you wait for the market to flush, well, look at how many dividends you miss collecting in the meantime, waiting for the net asset value to go down. So you have to weigh that. Well, what's the right answer, Lan? There is no right answer. It's just different. You're going to get a different result. And you never know what it's going to be because you don't know if the market's going to continue down. And so you wait, say, well, I'm going to wait for the market to go down more. And so I'm going to miss, 4 dividends in the process of waiting for the market to go down. Well, maybe the market won't go down. And then you're going to miss 4 dividends waiting for something to happen that's not going to happen. That's why there's not a right and a wrong answer. It's just a different answer. In hindsight, we'll tell you, oh, yeah, I should have waited. The market went down. I could have bought them at a cheaper price. Yes, but you would have sacrificed 4 dividends in doing so. Now you have to do your math. How much was it worth? Was it worth it? Was it worth it? Was it worth it? Those dividends are huge. And if the market only went down 10%, you lost a 90% dividend, it wasn't worth it to wait for the market to go down. Right? So take that into consideration too when you're doing your investments. So we got 2108. What's it trading at? TSHOOY is not trading at 2108. It's trading at 2112 at the low price. Let's do that one. And then the dividend on it, let's look at this. Is 60 cents, 58, 60, 69. Let's just go with the even 60. So we'll just say 60 cents. All right. So now let's go over and look at HOOY, which is the yield max version. Now remember, the yield max version makes more money when the market is rising. And the HOYY will make more money when the market falls. HOYY, HOOY. Because one's put options, one calls options. So this is currently trading at $60, $60.10. And the dividend on it is $1.25, $1.34, 73. Ooh, that was a big one, $6. But I think that was a reconciliation. That was still a monthly payment. So we're going to go off of these last 3. So 73 with 134. Let's just do 125. 125. Okay, so we got the numbers. Now let's go put those into the calculator. So the calculator is, so this is put it in the right column, Lan, HOOY. And share price for HOOY was 60.10, and the dividends were 1.25. And it's paying weekly. So then we're going to come up here, and this one is HOYY, and the share price was 21.12, and the dividend was 0.60. All right, and it's paying weekly. All right, we're going to put in $10,000. Calculate. All right, so the HOOY is making 108%, and the HOYY is 147%. So HOYY, Granite Shares, is kicking some royal hiney. They're doing really well. I'm really happy about the new Granite Shares funds. They're doing really well. They do put options. Cash secured put options. They're actually not even cash secured put options. They do what I call a soft stop put option. So if the market flushes really hard, they're going to actually be protected pretty well because they have downside protection, whereas YieldMax does not have downside protection. So these are really good ones. So if you wanted to, let's say you wanted to have 3 stocks in your portfolio, you might want to do something like you could do HOYY and TSYY, and you'd have just those 2 stocks right there would just absolutely dominate. Paul says he looks like the math is not working on this one. It doesn't look right to me either, Paul. I think we're going to have Grok go double check his math. That's Grok did that for us. I'll have him double check that today. Yeah, we got to have him double check his math. The thing is, if this one's off, then that one's off too. I think these are correct. I think going down this column without reinvestment is correct. I think where we're getting screwed up is with reinvestment. And I'm going to have to double check it. I need to double check it myself manually first, see if he's right. All right, let's see. Any other real quick questions? Got it? Things. What's the URL for the calculator? Did you get the URL? It's right there, pitnews.com/dividend-calculator, all lowercase. All right, I think I've covered all the questions anybody's posted. All right, guys, that's all I got for you today. We're going to let you go home. Or actually, you're probably already home. We're going to let you go, and we will catch you. Today is Thursday. Tomorrow's Friday. So tomorrow evening at the university, we're going to have Ben come on. He's flying in all the way from Nashville, Tennessee to talk to you guys and show you how to build a portfolio. He's going to take this to the next level. He's going to come in here and he's going to show you how you're going to take these and decide which ones you want to put in your portfolio and what your percentages are, all right, and how to reinvest your dividends, which is so once we set up our portfolio and our dividends start rolling in, how do we reinvest those dividends back into the market to maximize our profit potential and to reduce our risk? All right. Okay, guys, that's what we're going to be learning next time. And then, of course, next week is a break, but we're going to keep doing our classes here on the web. All right. We're going to still have these classes. We're not have classes at the university, but we're still going to be doing classes here where we're going to be discovering more things because I have to still teach another class on that. I still have more to tell you because it's not all roses and gardens. All right. It's not all candy and cake. There are some things we have to be mindful of these things because there is a nasty side to it. And I haven't approached that at all. So we have to talk about the nasty side of these things too, because there is a downside to them. And I just haven't had a chance to teach that class. We'll teach that next, probably Monday or Tuesday in the lab here on YouTube. All right. So then we'll go through that because I don't have another class at the university where I teach any of this stuff until next semester. Next semester, we'll go through this stuff again and we'll change it up some more. So if you want to come and join us in the class, every time I try to teach the class, basically the structure is basically the same, but all the new stuff that happens and all the extra stuff, we change it up and we talk about all new stuff. So it's fun. The university classes are not static. All right, guys, we will see you tomorrow evening at the university, and we'll have Ben as our guest speaker. Take care. All right. For those of you who have not bought Pitt News Magazine, I'm going to give you one more little encouragement right here, right now.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pitnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, there you go. So we will catch you guys tomorrow evening. Have a good.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.